Pepsi shares higher on strong quarterlies and an upbeat forecast driven by continued pricing power. The CFO on Squawk Box earlier said price hikes are critical to managing higher costs.
It's a combination of, look, we invested in our brands. We're actually seeing good consumer response despite the fact that we've had to increase prices. And we've got our cost structure under control very well. So we delivered a superior result.
So which other consumer staples still have pricing power? Let's bring in Chris Carey, Wells Fargo Staples analyst. Chris, talk to me a little bit about the Pepsi report today. It sounds like they're just doing fine. They're selling well, and they do have pricing power. People are willing to spend a few extra pennies on Doritos, chips, and drinks.
Yeah, that's right. You know, Pepsi results probably will stand out as one of the strongest in Staples reporting season this quarter. Organic sales very robust, 17% growth in pricing, volumes down just 1%, and earnings up 10%. Despite a commodity environment which cut their operating profit by roughly 40% before pricing actions. It's a really significant commodity hit, and yet they're still growing earnings. So it's pretty impressive, and certainly the pricing power is on full display here.
So who else has got what Pepsi has?
Well, this is quite unique, right? Across the staples sector, what we've seen is elasticities have been remarkably low. Part of that is because everybody is pricing. When everybody's pricing, there are a lack of alternatives, and as such, you see lower elasticities. We're seeing that, but certainly relative to the inflation that Pepsi has been seeing, the pricing it relative to how much volume impact they're seeing, which is fairly minimal, is very impressive. That's part of the scale of the business. It's part of the dominance of some of their categories, specifically in food. But we're seeing a high level of pricing power across food and beverage specifically, and we're seeing a little bit less so outside of that in staples, say in your household product space. But we are seeing elevated pricing power across the space. Pepsi would just be at the high end of that.
Okay, so just to dig into that a little bit further, I mean, you've got a neutral rating on Pepsi. Are there names that you would buy here, given the conversation we're having?
Well, look, the neutral on Pepsi is really a function of, you're trading at 23 times earnings. It's the high end of its 10-year average. It's the high end of its 20-year average. It's a 50% premium to the market, right? Staples will outperform so long as global growth continues to decelerate, right? It always does that. Staples only underperforms the market once growth starts to re-accelerate. So I suspect relative to the overall market, Pepsi could be an outperformer. But within the market, look, we have a name where, valuation is actually at the high end and earnings probably aren't going up that much more. And so what you really need to call for here on a Pepsi is multiple expansion. Nothing wrong with Pepsi, and their performance is quite impressive. It's just really you're getting to a point on the valuation. There are some other names in the sector where things probably get a little bit worse before they get better. In general, Q3 earnings is going to be a challenge. Most of these companies are going to be reflecting higher currency pressure, not a whole lot of commodity deflation. So despite the fact that earnings are going to be okay, we are going into an earnings season where outlooks are going to be relatively more pressured. Pepsi's just at the high end of the valuation
Put
range.
some names on that thesis that you just said, which is that some of these other companies that you follow are not going to have the kind of quarter that Pepsi had. They're going to have pressures. And then conversely, which ones, I mean, you have a neutral on Pepsi, largely because of its valuation, I take it. Which ones do you think are both attractively priced and able to benefit?
Well, look, you look at like an Estée Lauder, right? There's a company that is dealing with still some China headwinds. Mm-hmm. They're going to have FX pressure. Okay. They very well may play out in the upcoming quarter. But at the same time, you have a company that's trading in line with its 20-year average on valuation, and China's materially under-earning on potential that now we have currency getting factored in to the outlook, right? So I'd put that into one of those camps of, hey, currency has to get factored in. China still hasn't recovered, but could. And all of a sudden, you have a stock that could see multiple compression just because earnings reaccelerate with a cyclical recovery in China. Those are the types of stories that probably don't become so obvious on Q3 earnings, because you need to go through the currency pressure first and some other things. Mm-hmm. But that coming out of it, they do screen much more as a recovery play versus, say, a Pepsi, which is just delivering fantastic results. That's been the case all year, and going into next year set to do the same.
It's very interesting to see how you think, Chris. Thank you very much. I appreciate that. That was interesting.
Shepard Smith here. Thanks for watching CNBC on YouTube.